Welcome to Talk Tickers, your shortcut to actionable insights from earnings calls. Today we're diving into Norfolk Southern, ticker NSC, specifically their Q3 2025 earnings call from October 23rd. And, well, this one's a bit of a puzzle, isn't it?
It really is. You've got this situation where internally things look pretty good. Strong operational execution, a nice bottom line beat, stuff you'd normally cheer for.
Right.
But then you have these huge external clouds hanging over everything, intense competition, and of course the massive uncertainty around that proposed Union Pacific merger.
That's the core tension then. Strong operations versus these big outside risks.
Exactly. That's the dynamic we really need to unpack for you today because it explains so much about the market's reaction.
Okay, let's get into those headline numbers first, the ones that kind of set the stage. The bottom line seemed pretty clean at first glance.
Yeah, adjusted EPS came in at $3.30. Consensus was what? Around $3.19, $3.20. So solid beat there by $1.11 circa.
For revenue, not quite the same story.
No, revenue was $3.1 billion. Basically flat, up maybe 2% year over year, but it did slightly miss the street's expectation of $3.11 billion. So a bit soft on the top line.
And the efficiency metric? The operating ratio or OR?
That's where they focused. The adjusted OR improved 10 basis points compared to last year, down to 63.3%. Lower is better, means more efficient.
And normally, better OR, better margins. The market likes that, especially when revenue is flat.
Usually, yes. That's the classic rail story. Find efficiencies, improve the OR, even if volumes aren't booming.
But wait a second, before we celebrate that OR number too much, I remember seeing something about a pretty significant one-off item.
You caught it. Yes, you absolutely have to mention the land sale.
How big was it?
They booked $65 million more in land sale gains this quarter compared to last year. And it sounds like it was mostly one big deal that closed right at the end of September.
Okay, so $65 million on $3.1 billion in revenue. That's not insignificant. That definitely colors that 10 basis point OR improvement.
It absolutely does. You can't really call the OR improvement purely operational or organic when you've got a boost like that.
Yeah.
And I think that's exactly why the market reaction was so muted.
Right. Despite the EPS beat, the stock actually went down the next day.
Yeah, closed down $3.33, which was 1.17%. So investors clearly looked past the headline EPS number, saw that land sale, maybe worried about the revenue miss and the underlying volumes. They weren't giving full credit for that OR.
That divergence is fascinating. Okay, so let's drill down. If the overall numbers are a bit clouded by that sale, what about the actual segments? Volume was flat overall, you said.
Flat overall, yeah, but the mix tells the story. The strength was definitely in merchandise.
Which includes?
Things like autos, chemicals, metals, construction materials. That segment saw volume grow 6% year over year. Decent sign for the broader industrial economy, actually.
Okay, so merchandise was good. What about the weaker spots?
Headwinds came from intermodal and coal. Intermodal volume was down 2%.
And that's hit by a couple of things, right?
Exactly. One is just the trucking market. Still tons of capacity out there on the highways, which puts pressure on pricing for moving containers by rail.
Makes sense.
And the second factor, which is really crucial here, is competitors starting to react to that potential UP merger. We'll definitely come back to that.
Okay, and coal?
Coal was the biggest drag. Revenue per unit, or RPU, dropped 7%. That's mostly about falling prices for coal shipped overseas, the export market.
Even if domestic demand was okay.
Yeah, they said utility demand, so burning coal here in the U.S., was stronger. But it just wasn't nearly enough to make up for that weakness in the higher margin export business.
So a real mixed bag on volumes, but you mentioned earlier, management's really focused on what they can control.
Absolutely. Cost and productivity. That's their mantra right now under their PSR 2.0 strategy. Precision scheduled railroading, the sequel.
And are they delivering?
Seems like it. They hit a new quarterly record for fuel efficiency, up 5% year over year. That's real savings. And they're cutting assets where needed. Intermodal train starts were down 12%, and they've hired 19% fewer new recruits so far this year. They're trying to match the network, the current demand levels.
And they put a big number on future savings, too, didn't they?
They did. They significantly raised their cumulative productivity target, now aiming for $600 million in savings by 2026.
Wow, $600 million. That's a serious commitment. It gives them a lever to pull, even if volumes stay soft.
It's a huge lever. It provides a sort of operational floor, a baseline level of performance they believe they can hit through sheer efficiency, regardless of the market.
And alongside the cost cutting, how's safety looking? That's always critical on rail.
Yeah, and they highlighted improvements there too. The main FRA metrics, personal injuries and train accidents both showed significant improvement year to date. Better safety means lower long-term costs from claims, too.
Did they mention any tech helping with that?
They did. They talked about these new automated inspection portals. They have 8 in service now. And get this, they claimed these portals have already helped flag issues that prevented over 40 potential derailments.
40. That's incredible. Huge for reliability and obviously safety.
For sure. So you piece all that together, the cost discipline, the efficiency gains, the safety focus, that big $600 million target, it paints a picture of a company executing really well internally.
Which brings us right back to that disconnect. Why did the stock drift lower with all that good operational news? You said it comes back to the merger.
Squarely. The merger overhang and its immediate impact. The CEO was explicit about it on the call.
What did he say?
He specifically mentioned revenue erosion from competitor reactions to the merger announcement. Said it started showing up late in Q3 and they expect it to get worse in Q4 and into next year.
Okay, slow down. How exactly are competitors reacting? What kind of business are they losing?
It seems focused mainly on that Southeast domestic intermodal business, specifically the non-premium stuff and particularly interline traffic.
Interline meaning traffic handed off between railroads.
Exactly. Stuff that requires cooperation. And to think about it from a shipper's perspective, NSC and Union Pacific announced this massive merger plan. It still needs approval from the STB, the Surface Transportation Board. That process takes time, creates uncertainty. Maybe integration causes service hiccups down the line.
So competitors see an opening.
Right. Imagine you're CSX or BNSF. You go to a shipper using NSC for part of a route and say, look, who knows what happens with this merger, potential disruption, regulatory hassle. Stick with us. We can offer stability right now. Maybe they even sweeten the deal short term.
That's a pretty powerful pitch when supply chains are already fragile. It confirms what investors were worried about, that the merger itself could cause near-term pain even before any potential benefit.
Precisely. It's not just theoretical risk anymore. Management confirmed it's actually happening now.
But management sounded pretty confident they could win that business back, didn't they? They talked up their network, the unrivaled intermodal franchise, the Crescent Corridor.
They did. They're very bullish long-term. They argue their physical assets are superior, and once the merger uncertainty clears, or if it's approved and synergies kick in, they'll be in a stronger position.
But if that franchise is so unrivaled, why are they losing business now? Is that confidence maybe a bit optimistic? Losing share is losing share, even if you hope to get it back later.
That's the skeptical view, and it's a fair question. Market share can be sticky. Rebuilding trust and volume takes time and effort, maybe even price concessions. Management is betting on the long game, banking on structural advantages and eventual merger benefits. But near term, the damage is real.
And it's hitting the Q4 outlook too, compounding the issue.
Yeah, it's not just the competitive poaching. They also flagged pressure on auto production because of a supplier issue somewhere, plus ongoing uncertainty around tariffs and trade impacting import volumes for intermodal.
So when you see NSC stock underperforming CSX and UNP the day after the call,
it really suggests the market is pricing in these NSC-specific risks. The merger uncertainty, the confirmed competitive losses as being more severe than just the general macro headwinds affecting the whole sector.
And we also need to remember those costs we talked about earlier. They don't just disappear in Q4?
Nope. Those merger-related costs, $15 million in Q3, they'll continue. Plus, they mentioned elevated claims expense. Not because safety is getting worse, it's improving, but because older claims are settling for more money due to, well, social inflation.
So the cost guidance for Q4 reflects that.
Yeah, guided to a $2.1 billion range. Yeah. Signals they expect operational gains to continue, but they have to offset these other headwinds.
Okay. This sets us up perfectly for our favorite segment. Welcome to This Is Not Financial Advice, where we spin out an outrageous but maybe plausible trade idea based on everything we've just discussed.
All right, let's frame the core problem again. You've got this massive disconnect, right? The market is clearly worried, pricing in this competitive loss and the uncertainty around the STB decision.
But underneath that,
you have management executing well operationally. You have that newly raised, very concrete $600 million productivity target providing a potential floor.
So the idea is to isolate the event risk. The operations provide a base, maybe a soft landing, but the real potential swing comes from that STB decision on the merger.
Exactly. How do you play just the catalyst? Bypassing the noise around near-term volume weakness.
Okay, lay out the trade structure.
The core idea. You buy some out-of-the-money Norfolk Southern calls.
Yeah.
Key points here. Out of the money means they're relatively cheap, and you want ones with high gamma.
By gamma, meaning super sensitive to big price moves.
Precisely. You also want them expiring just after a likely date for a major STB decision or update. This is purely a bet on the binary outcome of that regulatory review.
This is like a lottery ticket. If the STB approves, the thinking is the stock jumps significantly as merger synergies get priced in, and those cheap calls explode in value. If it's denied or delayed badly,
You lose the premium you paid for the calls. It's high risk.
okay, that could be expensive. How do you maybe offset some of that cost?
This is where the other side of the market sentiment comes in. Because everyone's cautious right now, implied volatility in the options market is likely. Elevated options are expensive. You can use that.
How?
You could partially fund the purchase of those calls by selling a put spread. Maybe target strikes down in the low 270 degrees, somewhere near recent lows, or where that operational floor might hold.
So you're collecting premium by selling puts, betting the stock won't completely collapse below that level before the options expire.
Exactly. You sell that elevated volatility, the thesis ties together. You use the demonstrated operational strength and that $600 million target as justification that the stock isn't likely to fall off a cliff, limiting the risk on the puts you sold.
Let me see if I got this. You buy the cheap, high gamma calls to play the potential huge upside from an STB approval. You help pay for it by selling a put spread, betting the downside is limited by the company's operational floor, and using the market's current fear, high volatility, to get a better price for those puts.
That's the essence of it. You're paying to play the merger lottery, insulated somewhat by betting that the current operational strength prevents a total meltdown. It isolates the catalyst. Again, definitely not financial advice, just a thought experiment.
A fascinating one, though. Okay, let's wrap this deep dive up.
To summarize it for you, Norfolk Southern put up an EPS beat in Q3, really driven by strong cost control and hitting operational targets. They even raised their long-term productivity goal significantly to $600 million. But that headline OR improvement was definitely flattered by a big land sale. And more importantly, they confirmed competitors are actively poaching some intermodal business because of the merger uncertainty. That revenue erosion is real and expected to continue near term.
So the regulatory cloud around the Union Pacific merger isn't just a future risk, it's impacting results right now and overshadowing the operational positives in the market's eyes.
That seems to be the clear picture. Management's focused on controlling costs, safety, service the things they can control, creating that operational floor.
But the investment story and the stock's performance right now really hinges on that big uncontrollable variable, what the STB decides about the merger. Thanks for joining us for this deep dive into the Norfolk Southern earnings call. We'll talk soon.